Hey traders, Jeff Tompkins, Chief Investment Strategist at Altos Trading. With markets hovering back around all-time highs, the risk of false breakouts and whipsaw conditions becomes elevated. To help you prepare and trade this type of market environment, I put together a complimentary video demonstrating how you can take advantage of false breakouts when they occur. Enjoy.
So let's talk a little bit about trading false breakouts and breakdowns. So when I say breakout, I'm just referring to an upside, like breakout through resistance, and then a breakdown would be a breakthrough support. But I'll go back over just to the SPY here, since we're there this, as of today, this week. Okay, so uh, a few things I use for levels, right? So the weekly, it doesn't have to be weekly, it could be a daily expected move, weekly or daily expected move, or monthly expected move. But an expected move level, okay, and and then the static and dynamic support and resistance levels that we map out each week. Okay, so those are key levels, and then the other thing is if we go over to the options chain, are strike prices that have heavy open interest in volume. Okay, those can also serve as support and resistance. Um, I'm on the SPX still. Let's go over to the SPY. All right, so like if we look at the 700 level, right? This is actually kind of interesting. Normally, I would expect to see this open interest at the 700, not the 701. This is actually kind of indicating to me that there may be positioning for a breakout here or a false breakout. Open interest is stacked up at the 701 strike. You typically will see this at a roundy like 700. But nevertheless, there's still uh, significant open interest relative to the 699 strike, right? Um, about triple. So these are also levels. So when you see price approach a strike level with heavy open interest, okay, you'll often see it reverse off of that. Or if it breaks through it and sustains that breakout, like on a closing basis, you'll often see an acceleration in that direction of price, and that's due to dealer, gamma hedging. So when dealers are selling these call options to retail call buyers, right? They're now short call options, and broker dealers are not in the business of taking directional risks, so they will buy shares of the underlying stock to delta neutral hedge. And so as people are coming in and buying calls, um, and the price is moving up, these are this 700 701 strikes. These are very low deltas, 7 and 5 delta. So if price continues to go up, these deltas increase. And so even in the absence of somebody coming in and buying calls, that delta increases and the broker dealer has to buy more shares to neutralize their delta as that delta increases. And that can push the price higher. But why these levels are significant is if you encounter one, like if we encounter 701, there's heavy open interest there. And if price doesn't manage to push through it, okay, and starts to reverse off of it, the delta comes back down and the broker dealer unwinds long shares to just do the opposite, to, delta neutral. They have to sell the shares as the price starts to reject a level. So that causes an acceleration to the downside. And this is one of the main reasons you get false breakouts. So this 700, 701 area is going to be key resistance if we get up there. And even though slightly below that, right, we identified weekly expected move and upper Bollinger Band and some other layers of resistance. Okay, those would have to be breached for us to get to 700, 701, but then that would be a fault. And, if this ultimately ends up being resistance, that would be a false breakout. So I look for confluence or alignment between like strike prices with heavy open interest and technical levels of static and dynamic support on the chart. Okay, so we're right there on the spike as of today. Okay, so high risk of a false breakout here. Now 700 is quite a ways up, right? But somewhere in this vicinity, it's very easy to get trapped on the long side. This is often how people get trapped on breakouts because if the S&Ps, the SPY, continue to rotate higher here into this range, okay, the risk of a subsequent reversal back down becomes very high. Now, so how would I trade a breakout on this? Do I want to buy SPY in this neighborhood? No, because I've already identified, looking at the options chain and the heavy open interest, it's the 700, 701 strikes, that those are very likely to serve as resistance. Okay, so if I want to take a long trade on a breakout, I need to wait for a close above 700, 701. Then I go long. In this area here, I'd be looking for a false breakout. So this is where other people would get trapped. So they're buying in this area. And then I'm looking for price to come back down below the level. So we actually built a conditional trade. So we haven't entered the trade yet. You can see I've actually got the order. By the way, where the toss plots this order has no bearing on where the entry is. So it's deceiving. Um, but we in the trade room today built a conditional trade that will trigger if this all plays out that way. So zoom in here. Okay, so if we trade up above the weekly expected move, and remember, we've already hit the upper edge, so there's a real possibility this week we push a little bit higher and then close back below. And then there's also this pivot. And there's also one back here. Okay, so there's all this prior resistance. Okay, so I can use these levels to build a trade around. So if we get a breakout here and then a subsequent rotation back below, then I short. And because of that heavy open interest we just looked at on the options chain, okay, that on the call side, right? We can then look on the put side. I'll go back over and look at all the open interest here. Okay, so all of this gets unwound as price rotates lower. Okay, so as price rotates lower, right, what happens? Same thing on the call side, the deltas increase. But here, if somebody's buying a put, the broker dealer's selling them that put. So they're not going to be short that directional exposure. They what? Short the SPY. Okay, so as deltas increase on the put side, they have to short more shares of the SPY. That causes the sell-off to magnify. Okay, so for the most part, the more prudent thing to do is wait for the false breakout. Know where the level is. That could be an expected move level, a strike price with heavy open interest. Wait for that level to be breached, and then wait for a close back below the level. Okay, and it's just all the opposite on the support side, right? So a breakdown of support, price trades below an expected move level, static horizontal price level of support or dynamic support, the lower Bollinger Band, and then recovers back above, you go long. Okay. But just remember, when it comes to expected moves, if it's the upper expected move, much more downside risk than upside potential. If it's the lower edge, always more upside potential than downside risk. Okay, so the better risk reward trade is in the opposite direction. Okay, off that expected move level. Um, okay, so the step process and the confirmation is wait for the level to be breached, and then wait for on a close on a closing basis. So like on the daily chart, right? On a daily closing basis, wait for a price to close back either below if it's a upper edge or a resistance level, or above if it's a lower expected move edge or a support level. Okay, and then you just take it in the opposite direction. Here was an example back here, right? We had well-defined prior resistance. So back in November, looks like maybe even October. So I extended this further back, right? We have obvious prior support and resistance that was breached here. Then we close back above. Okay, false breakdown traps people on the short side. The patient trader waits for that break, and then yeah, this could have kept going, and then you're not in the trade, you miss out. Okay, fine. But the better risk reward profile here is close back above, then you have a high probability trade with a good risk reward profile. Okay, here was a recent example in later December. Okay, once again, we at that point in time would have known that there was this strong resistance at or around 690. Okay, we would have known that because of here and here. Okay, over 2 days, and I don't know where the expected moves were at this point in time, but wouldn't be surprised if these corresponded to a weekly expected move, right? It looks like we're getting a breakout. Okay. People get trapped on the long side. We get a close back below, you short. And then you can use that level to define your risk. So you could put a really tight stop in here at the level or just above the pivot, right? And you've easily got 2 to 1, 3 to 1, or even 4 to 1 risk reward. So that's where we are now, right? We're breaking out of a pivot, an upper edge of expected move, and resistance. So it could certainly continue, but high probability trade is wait for a close back below the level and then take it on the short side. And then if you do go long, don't don't expect as much upside potential, right? So once you've breached a weekly expected move, if you take the trade in that direction, don't expect a whole lot of upside. You don't want to be placing profit targets too far outside of that, right? Especially on the upside. Obviously, when markets sell off, right, it's the adage markets take the stairs up and the elevator down. That can be a little different, but always take that into consideration as well.